Hello, everyone. It's Stephen Whiteside here from theuptrend.com with this weekend's edition of Protect Your Portfolio. Well, this presentation may take a little bit longer than normal. There's two parts to it. First of all, we will be looking at the stock market, which did not have a pretty week. At the same time, we're celebrating our 25th anniversary. And we've been popping the champagne this week and trying to reminisce on things that have gone by in the past. If you don't know the history at all, back in the 80s, I was trading commodities using seasonality charts. So I was able to travel around the world and trade at the same time because I knew in advance what trades I was going to do every month. And I'd put my orders in by fax. You could use the fax machine at the hotel lobby, and I put the orders in the morning. I'd get a confirmation back. And then at the end of the day, there'd be a fax telling me, what the account status was at the end of the day. So I had all the freedom in the world. I knew what I was doing every month. And then 87 came up. And in October of 87, my broker, Brian Castleman, said, "Hey, you don't have anything going on right now." And I used to move my cash into T-bills when I didn't have any trades going on. And he suggested that, hey, all of us, him and his buddies at the office, we're all short the S&P 500. Why don't I just, take some of your money and buy, short a few futures contracts? So back then there was no minis; these were the big contracts, and then the stock market crashed, and nothing. I had no intuition, nothing I was looking at, nothing in the media. There was absolutely no reason that I would have been short the stock market at that time. But because of Brian suggesting that I follow him and his technical analysis, I made a fortune when the stock market crashed in 87. So that was the day that really changed my life. I committed myself to learning about technical analysis from that day and then started a new business in which I was just trading the S&P 500 futures contract each day, and through the trading forums and the programming forums of how to write trading systems, I met a young man from Moscow by the name of Sergey who, helped me a lot, fixing my programming and making suggestions and fine tuning stuff. And we became partners, and we traded the S&P 500 futures contract. That is the only thing we looked at every day. We didn't watch the news. We didn't listen to the news. We just traded the contract using technical analysis, using systems that we had developed, and it was great because he's in Moscow. He's on different time zones than I am. If I have to go out, if I've got a doctor's appointment, if I want to go out for lunch, he could watch my trades. He's got to take the kids to school or pick them up or whatever. I watch his trades. So it was a great partnership. Unfortunately, that came to an end when Sergey unfortunately was in a car accident and lost his life a few years ago. So sorry, I had to take a little break there. I get rather choked up thinking about Sergey. It just seems like yesterday that we were both watching what happened on 9/11. We were halfway around the world from each other. We were watching it at the same time, chatting at the same time. And, we felt very guilty that day because we were both short the market on 9/11, and we were about to make a lot of money while, the rest of the world was not having a good day. So it brings back a lot of emotions. Now, up until 1999, nobody that I knew cared what I did. Nobody I knew, my friends, my family, the people I grew up with, people I went to school with, none of them were actively involved in the stock market. And then as the dot-com bubble was going up, all these people ended up having shares in Northern Telecom. And what happened was Bell Canada, a very, blue chip stock that paid a regular dividend that was in everybody's portfolio, spun off Northern Telecom. And the next thing you know, all these conservative investors that didn't know how to buy and sell shares, they basically deposited money in their retirement account every year and people bought shares for them. And next thing you know, they've got Northern Telecom going up and up and up and up, and they didn't know what to do with it. So I started posting online, mostly weekly charts because daily charts weren't going to help these people. They weren't traders. But I was just trying to explain, yes, I agree with you. Northern Telecom is going to $100,000 a share, but it might take a break along the way. And, I never told anybody it was going to zero because you don't know that. But, when a stock goes up as much as any of these dot-com bubble stocks did, they were going to come down at some point. And so I was just posting regular charts. That got to Stockhouse. Stockhouse had me do a regular segment, and it went from posting Northern Telecom charts to posting Microsoft and Cisco and WorldCom and all the other stocks of the day. And then what was, taking me 5 minutes a day ended up taking an hour, 2 hours, 3 hours, and that's how we got to the uptrend.com. And back then, the technology was not there. Not everybody was on cable. A lot of people were still up on dial-up. The computers that we were using, even though we spent a lot of money on computers, they still weren't fast enough to render a lot of the charts. So the panic zone chart, for example, didn't come in till years later, because we just didn't have the technology to pump out, a panic zone chart for every symbol that we were following. It might take 5 minutes to render the chart, and you couldn't use that in daily production. So some of the charts that we have today, we didn't have back then just because of technology, but that's all been taken care of over time. So that's all I wanted to cover. It's been 25 years, and I'm shooting for 25 more. And thank you very much for your all your support over the years. Now let's get back to our regularly scheduled program. And I posted this when Trump got reelected, not when he took office, but when he got reelected, that the next 4 years may be the worst 4 years since the Great Depression. Now, this is not a commentary on the stock market. This is a commentary on everything else but the stock market. So, housing prices, mortgage defaults, crime, suicide rates, just what life is going to be like for the average person is just going to be terrible in the next 4 years. I still believe that. And in fact, I think it's moving ahead faster than I was expecting. When he also got reelected, I mentioned, and I got a lot of hate mail for this, but if you live in a red state, you should probably move, because most of the red states are actually known as welfare states, and they get a large percentage of their money from the federal government. So they actually live off the blue states. And if Trump's goal is to take away all that money, so money from universities, money from hospitals, money from the military, if they're going to take away all that, the states that are going to get hurt the most are the red states. And what's really funny is that two of those red welfare states are actually thinking of getting rid of their personal income tax. So now they're going to need even more money from the federal government, which is not going to come under the Trump administration. So it's going to be pretty ugly for those particular states. Now, while things may be falling apart for people on an individual basis, the stock market can be held up for a long time because of moves from the Fed. A lot of the gains that we've seen in the stock market over the past few years have been because of stock buybacks, because of companies not giving money back as dividends, but rebuying their shares. And also, things that happen internationally can also prop the stock market up. So if we get a failure, if China's not looking good, if Japan's not looking good, if Europe's not looking good, money can come out of those markets and prop up the North American markets at the same time that North America could be crumbling while that's going on. So the fact that the country might be falling apart does not mean the stock market has to fall apart going forward. Now, history tells us that the majority of stock market crashes happen when a Republican's in the White House. Republicans in general are not very good with other people's money. You can see that at the local, state level, and you can certainly see that from history going back to when Republicans were in office. They usually push up the deficit dramatically and crash the stock market at the same time. So I would never vote for one, but then I don't have that opportunity. Now, when Trump took office, I said that his goal was to raise inflation and to cause a recession, and both of those plays are still happening, and they're probably happening faster than I expected. I also told you at the time to read up on German history, and things are unfolding just like they did in Germany in the 1930s. You tell people not to believe the media, the government, the police, the courts. You just walk through all of those, and you're trying to destabilize the country so you can do something with it that the normal citizen wouldn't want to do. But that's what's going on right now. That has not changed. Well, Trump believes that these tariffs are going to raise $6 trillion, which they're not going to do. And he still doesn't understand how tariffs work. I know that some companies have stopped exporting to the United States, as these tariffs were announced. So sales of those products are going to go down. So they're not going to get $6 trillion. He still doesn't understand how tariffs work, and he thinks that other countries pay them, and that's not what happens. And when I listen to him talk about tariffs, to me, it sounds like a 5-year-old explaining where babies come from. It's just unbelievable that this man got elected. But here we are. These tariffs were tried in 1828 and 1930. Both times they led to depressions. And so this time we're going to roll the dice and see if it'll work 100 years later. You've got to give this strategy 100 years to breathe between each time you attempt it, because it ends so badly that you want to wait till all the people that went through it are dead before you try it again, because you really don't want anybody standing up and just talking about how it worked out last time. Now, the first time that Trump was elected president, the world couldn't stop laughing. They couldn't understand why Americans would vote for somebody who's totally unqualified to run a country. Business failure, most famous for not paying his bills. Yeah, he was on TV, but he was on a scripted TV show. He didn't do anything intelligent on that show. Now, the second time he's elected, we're not laughing anymore. The rest of the world really hates the United States at the moment. And, as a brand, the United States has just slipped off the radar screen. It's like nobody wants to visit, nobody wants to buy US products. It's just been a disaster, and it should have never happened. But it has happened. You've got a crazy man running the country, doing all kinds of stupid things, and it's really caused other countries to come together. And I know in Canada, we haven't been this focused on one topic as a nation since we ended the Cold War with Russia in 1972. Even the people in Quebec that normally are very quiet Canadians are now, waving the Canadian flag like never before. So thanks, Trump, for that. But it's not, helping the average person in the United States at all. Now, let's move on to the stock market at hand, and we'll start off with a little housekeeping. Some people have asked me why I don't follow the Vanguard Total Market ETF. The reason for that is it's not an equal weighted ETF, so it has the same problem that the S&P 500 and the Nasdaq 100 have, and that is those big cap tech stocks eat up a lot of the particular weighting in this ETF. So it's not that important to me. I'd rather use the Russell 2000, where I can watch for risk on, risk off action. And the Russell 2000, we've got several versions of it, but it all looks the same, whether you're looking at the cash index, the futures contract, or the ETF. It's the ETF that I mentioned the most. And you can tell risk on and risk off. If the Russell 2000 is leading the market higher in percentage terms, that tells us that money is coming out of those big cap tech stocks, going into riskier mid cap stocks. There's a big difference between the class of stocks, because the mid cap stocks generally don't have cash. They're working off of borrowed money. For the most part, they're not making that much money compared to those big cap stocks, and they're certainly not paying a dividend. So when investors get into these stocks, that's a bullish sign for the market. It's also a very bearish sign for the market if these stocks are leading the market lower. And so when we look at this particular situation, the Russell 2000 peaked in late November. November 29th is when it peaked. And compare that to the NASDAQ 100 that didn't peak until February 21st. And so there's a big difference between the broad market in the Russell 2000 and those handful of big cap tech stocks that everybody's been focused on. So while they were continuing to trade higher into 2025, the Russell 2000 broke down in December 20th of 2024, and it's been moving lower ever since. And so that has been the risk off trade. Now, I want to go back to this monthly chart that we posted just after the year end. So this is up until December 31st. We were looking for the Russell 2000 to go up to 250. That was our next target. If we could break through that, then 275. The peak back in 2021 was $244.46. So we went a couple of years, we made it all the way back up, and we got as high as $244.98 in November. That's where the Russell 2000 peaked. And then we came down, even though we were trying to get to 250. In December, we came down and closed below the 225 level, which is where we would have been looking for support. We actually closed at 220.96. So that was a very bearish move. And then, of course, I always tell you to look 2 lines up, 2 lines down. So 2 lines up from there would have been 275. 2 lines down, of course, is down to 175. That would have been our playing field at the time. We don't like to, have projections way out of bounds, we like to go 2 lines at a time, and that way, we can manage reasonable expectations. I wouldn't have told you to look down to 150 from 225. 175 would have been a reasonable move, and on Friday, we got down to that level. The low of the day was $176.67, so $1.67 above our target. Now, 2 lines down from here takes us down to 150, but to get to 150, we have to break through the low of the fall of 2023. So, that is certainly a reasonable target to the downside, the 162.50 level. The market will try to look for support there. If that breaks, then 150 is certainly our next target. So to look for the risk on, risk off trade, you can use mid caps, you can use small caps, you can use micro caps. They all will tell the same story. The Russell 2000 is the bigger and broader one, and it's the one that I like to follow. Now, semiconductors were down over 17% on the week. We saw NVIDIA break the $100 level, and we saw semiconductors start to trade below the November of 2023 low. So that is not a good sign going forward. And it broke down below its 200-week moving average, which was acting as support for the last couple of weeks, and it certainly crashed through that. So that is a very bearish sign going forward. Now, even though we've had some bad days and the market has sold off sharply, we still haven't had the circuit breakers turned on yet. So we still have some fun to look forward to on the downside. Now, looking at the VIX popped. It was up over 50% on Friday. The VIX ETFs were up sharply on the day. So congratulations, anyone along the VIX. Now, from a long-term investor's point of view, we're going to remain long-term bearish on the market as long as the VIX doesn't close below 1752 this coming Friday. The VIX usually pops and pulls back fairly quickly, so you want to be selling in to spikes in the VIX, and I think the VIX is going to go up to 62.50 this week. At the same time, the VIX can retreat very quickly. That does not mean it's going to change trend. It's just going to come down very, very quickly, and that may not turn or change our long-term view on the market, but it will still take some pressure off the market, and you want to be selling into the strength in the VIX before it starts to pull back very quickly. Now, stocks generally go up slowly and fall very quickly. That's what's going on right now. So when we look at the Dow, the S&P 500, the NASDAQ 100, they're all coming down sharply. We talked about the Russell, the small caps, the micro caps. Gold stocks pulled back this week. And as I explained in one of the daily videos, is that gold stocks will not hold up if the stock market starts to roll over. Even if gold holds up, even if gold continues higher, gold stocks are going to come down with the rest of the market. Insurance companies held up fairly well last week. They came down hard this week. We had pharmaceuticals down sharply. We had cloud computing stocks come down sharply. So it was a wide-ranging sell-off this week. Let's finish off looking at the Canadian market, and we are down across the board. So the TSX 60, Vanguard, Canada, small caps, micro caps. We had the financials. We had banks down on the week. We've got the energy sector down sharply over 12% on the week and still on a weekly sell signal, so no change in trend. Gold stocks came down hard, still on a buy signal here, but gold stocks are going to come down with the rest of the market no matter what the price of gold does. We've got Infotech down over 10% on the week. Base metals down 18% on the week, so no change in trend there. I've just got a couple more charts to go. This has been a very long presentation, and I appreciate you sticking with me. Copper dropped sharply this week, down over 14%. So it looks like a lot of copper users have been buying ahead of the tariffs. Now that the tariffs are kicking in, they've ended all those orders, and we're back to where we were at the start of the year. Coming into a recession, crude oil prices dropped sharply. They're still on a weekly sell signal, so no change in trend. For those people yelling, drill, drill, baby, drill, it's not going to happen. You need crude oil prices up over 75 to attract people to invest in new drilling, and that isn't about to happen anytime soon. So unless crude oil turns around sharply here, we can certainly enjoy the lower gasoline prices going forward. That is good for consumers, not necessarily good for the energy industry. Now, right now, I think it's the riskiest time to be an investor in my lifetime. The reason for that is Trump has declared war on all the countries around the world, including Canada. There has been a movement over the last decade or so for a lot of countries to get off using the US dollar for international trade. I think that movement is going to be accelerated. And once those countries come off the US dollar is going to be a lot weaker. That is also true for the bond market. Trump has declared war on China, for example. They are big holders of US bonds. If China decides to diversify themselves away from those US bonds, that could help to crash the US market. And the last thing I want to mention, which is the scariest of all, is the Trump administration is going through with a chainsaw trying to destroy everything about the US government. And if it overreaches and goes after the Fed, that's when things could fall apart dramatically. The Fed is not a government institution, it's a private institution in which the president has the ability to name a chairman. If he goes after the chairman, if he goes after the Fed, that could certainly spill over as a disaster for the stock market. And it's something we need to be all concerned about. If you're out of the stock market right now, if you're short the stock market right now, then you have nothing to worry about. But if you're holding on and hoping that things are going to get better and we're going to get back to what happened last year, that isn't going to happen anytime soon. The United States is worth about 30% less than it was a year ago, and it's not going to recover in the short term. So expect lower prices, expect bounces. We'll buy the bounces and sell them fairly quickly, and watch the market to continue to move lower in 2025. Now, on Sunday night, the Dow futures have started trading, and they're currently down 1,500 points. So, not looking for any recovery on Monday morning. Enjoy what's left of the weekend. Next time you'll hear my voice is on Monday morning.